Hi everyone and welcome to this video where we will go through an in-depth problem to show you how transactions that happen out in the real world, they get recorded in journal entries, and then those journal entries end up getting posted to T accounts in the general ledger, and then those T accounts are used to create the trial balance. So we're going to go through that entire process from the time we record the journal entry to the time we prepare the trial balance. So let's take a look at this together and see what's involved here. All right, so we have Janet Enterprises, and by the way, I'm doing this in a spreadsheet just because I think it will allow us to organize this stuff a little better than we would do in like a word processing document like Google Docs or something. So Janet Enterprises, they incorporated on May 3rd of the current year, and the company engaged in the following transactions in its first month of operations. So our job here is to, in part A, prepare the journal entries, including explanations for these transactions. So I'm not going to worry about the notes or the explanations here. I'm just going to record the debits and the credits. So May 3rd is our first journal entry, and we issued stock. That means we got invested, dollars were invested in the company by shareholders. So we received cash, so we're going to debit cash, and it's going to be for $95,000. And we are going to, because money was invested, our equity goes up. We're going to use the account. They tell us the account they use here. So they give us a list of accounts that they use. And we have dividends payable. Capital stock is the name of the account that we want to use here. So capital stock. This is the name of the account we use for when there's investment. $95,000. Okay. So we have our first journal entry recorded. May 4th. What happens on May 4th? So May 4th, they paid May office rent expense of $1,800. So we're going to say debit office rent expense, because they tell us here this is one of the accounts that they're using, and we're going to credit cash because we're paying cash for that rent expense. So anytime they say paid, you can assume that it's being paid with cash. Okay. All right, so May 4th is done. May 5th, what happens on May 5th? They purchased office supplies for $600 cash. So we're going to use this office supplies account, which is an asset account, and we're going to credit cash. So office supplies are, what did they say? $600. So $600. And then May 15th. May 15th. We say purchased office equipment for $12,400 on account. So May 15th, we're not buying office supplies, we're buying office equipment. Office equipment. And it says on account. What that means is the supplier told us that we could pay later. So we're going to use the accounts payable. Accounts payable. And that's a liability for amounts that we owe to suppliers, so $12,400. So if they didn't say on account, we could assume here that they paid cash, but because they say on account, that's telling us that they are they're paying later, so they have a liability. All right, May 18th. What happens on May 18th? They purchased a company car for $45,000. So the name of the account we want to use here, let's look at our list here, vehicles. So we'll say vehicles, and the amount of the vehicles, $45,000. And we paid cash of $15,000. And we paid a note payable for the rest, which is $30,000. Note payable is a type of loan. May 18th is done. Let's look at May 20th. May 20th, billed clients $120,000 on account. So that's saying we sold something to our clients, we're allowing them to pay later. We have what's called an accounts receivable. And we are recording revenue. So this would be client revenue. And this is for $120,000. May 26th. May 26th, they're telling us they declared a dividend of $8,000. That is income that we've made that we're going to return to shareholders. So we have a liability for dividends payable that we haven't paid yet. And the amount of the dividend is $8,000. And we're going to debit the dividends account, which is a retained earnings account, for the amount that our retained earnings goes down, so $8,000. We only have 3 more left. Hang in there. So May 29th, we paid May utilities of $500. So we're going to use this utilities expense account, utilities expense, and we're going to pay cash, and the amount is $500. May 30th. Received $90,000 from clients billed on May 20th. So notice we billed our clients $120,000 on May 20th. Now we're collecting the cash from those clients. So we're going to debit cash, credit accounts receivable. And this is going to be for $90,000. And then the last one here is May 31st. We've recorded and paid salary expense of $32,000. So we're going to say salary expense, $32,000. And we paid the salary, so we're going to say cash, credit cash, $32,000. All right. And so now we've recorded all of these journal entries for all of these transactions, and this is the answer to part A. So I realize it's quite a long problem here, but we're done part A. So this is part A. Part B, what are they asking us? Post each entry to the appropriate ledger accounts. Use the T account illustrated in Exhibit 3.8. All right, so we basically want to create T accounts here. And let's move this over. I'm going to take this, I'm going to move it into a new tab in this spreadsheet. So here's our journal entries, just so we have some space to work. So I'm just going to format these columns so everything fits. All right. So T accounts, remember, they look like a T. That's why they're called T accounts, right? So we're gonna let's actually make this thicker. All right, so we have the T here, and I'm just going to add this. All right, so we have a template for our T accounts here, and let's just merge these two. Okay, left-hand side debits, right-hand side credits. And the first one that we're using is for cash. But let's give ourselves some extra space to write here. All right, so I'm just setting up some T accounts. All right, so the first T account here is cash. Cash on May 3rd is for $95,000. So I'm just gonna say it's equal to this amount here. All right. So then we have cash of $95,000. We recorded this. I'm gonna highlight this so we know we got it. Capital stock. Capital stock. I'm gonna set up a new T account. Capital stock is also $95,000. And I'm going to use the formulas within the spreadsheet to make sure I keep these things organized. This is May 3rd as well. I'm just going to mark this, right? And I'm going to just put this to the left. All right, so we have the May 3rd amount there. This is done, okay? Office rent expense, that's a new account. Office rent expense. And I'm going to center this, and this will be for $1,800. And so I'm going to link it here, $1,800, and this is going to be on May 4th. And then the credit is to cash, and so this is going to be equal to this, and we're going to put the date of May 4th here. All right, and that's good. We're good to go there. So we took care of this entry. This is done. I'm just going to mark this so we know. The next one, office supplies. We're going to set up a new account because we don't have this account ready yet. So this is office supplies. And it's a debit to this account, so it's going to be $600. And I'm just going to add a column here so that I can put the date. So the $600 was on May 5th. All right, so we have May 5th. And the credit was to cash. And this is also for $600. So $600. Oops, I have an error here, so I'm just going to say this is equal to $600. All right, and this is going to be for May 5th. All right, so we have the May 5th journal entry done. And notice I'm just setting up the T accounts based on entirely on what's in the journal entries. There's really not much thought that goes into it once you have the journal entries done. Next one here, office equipment. Now we don't have that set up yet. So we have to create a new account, office equipment. And office equipment is going to be a debit for that $12,400. And this happens on May 15th. Got that. I can expand this a little, give ourselves some more room. And then we have accounts payable. That's also a new one. We haven't used that yet. Let me just copy this so that I have a template going here. All right, so this will be accounts payable. And accounts payable will be equal to a credit of $12,400. And the date of this credit is also May 15th. Just mark that. And you kind of get a sense for the process here, right? I bet you could follow along. And actually, why don't we do that? Let's speed this up. And I'm just going to fill in the rest of the T accounts here for these last 1, 2, 3, 4, 5, 6 journal entries. And then we'll come back and talk about it. All right. All right, so we've created the T accounts here and they're on your screen. And the last step here for part C is to create the trial balance. The trial balance can be created by listing out all of the accounts that we have T accounts for. And so what that means is we have a cash T account, we have a capital stock T account, office rent expense T account. And all we're going to do is just list out the account names for each of these T accounts. and we're going to put them in the rows of our trial balance, and that's what I've done already here for you. So I've taken cash, capital stock, all the way down through salary expense, which was our last T account that we created. And then for each of these accounts, you want to total up what's in the T account. So for example, cash, we had 95,000 and 90,000 on the debit side. So for a total of $185,000 of debits. You can see it down here on your bottom right. And then on the credit side, we had $49,900 of credits. And what we do in the trial balance is we say, if you take the total of the debits and you compare it to the total of the credits, if the debits are bigger than the credits, we will say that we have an account that has a debit balance. And what that means is all the debits made to that account are greater than the credits that were made to the account. Now, if it was the other way around, let's say all of the credits exceeded the total of the debits, then we would say that account has a credit balance. Okay, so whichever side is bigger that's the side that we put the total in the trial balance. So in this case, we have $185,000 of cash on the debit side, and then $49,900 on the credit side. And if we subtract the $49,900 from the $185,000, we get a debit balance of $135,100. So this number in the trial balance, I got this by saying take the total of the debits on the cash account and subtract the total of the credits. And then I listed what I get from that calculation on the debit side, because the debits are bigger than the credits in this case. All right, and we just do that for every single account. So we do it for cash, we do it for capital stock, office rent expense, office supplies, office equipment. Now notice capital stock is one where we only have one journal entry that affected the account. So the total for this account will be 95,000, and the credits exceed the debits. So 95,000 exceeds all the debits because there are no debits. And so for capital stock, we're going to list it as having a balance of $95,000, and it is a credit. Okay, and we do this all the way down. We do it for each account: cash, capital stock, office rent, office supplies, office equipment, accounts payable, vehicles, notes payable, accounts receivable, client revenue, dividends, dividends payable, utilities, salaries. And then once we're all done, we total up all of the debits that we've made. So total up all these, we get $265,400. And we total up all the credits, and we also get $265,400. And they equal each other, and the reason that they do is because we're using the balance sheet equation, which says that assets have to equal liabilities plus equity. So if we got a trial balance where the total of the debits were different than the total of the credits, we will know that we did something incorrect here. So this accounting equation that we keep referring to, it has this feature in it where it checks your work for you. If the equation doesn't balance, you know that you've done something wrong. Well, in this case, we've made a trial balance for Janet Enterprises, and our debits equal our credits, and they match up to our T accounts, so we're good to go. And so the answer to part C is right here on your screen. This whole thing that I have highlighted is the answer to part C. All right, well, I hope you found this video helpful. Thank you very much for watching, and take care.